Note recently issued by Zoltan Pozsar, head of Credit Suisse's short-term interest rate strategy and a leading voice on Wall Street, makes a bold prediction: the birth of Bretton Woods III. By this he means, in essence, a new world monetary order centered around a commodity-based Chinese currency, perhaps boosted by other Asian currencies, that will overturn the existing US dollar-denominated system. Based on how the global monetary structure has functioned since the end of World War II, this is, needless to say, a pretty radical idea. Is it realistic? A little history. The original Bretton Woods monetary system was formulated in 1944. The name comes from a multilateral conference held among the soon-to-be victorious Allied powers in Bretton Woods, New Hampshire. The conference established a post-war structure that pegged global currencies to the US dollar, whose value in turn was pegged to gold. Inflationary pressures and market speculation pushed the US to abandon the gold standard in the early 1970s. Since then, the world has operated a system of government-issued fiat currencies that are not backed by precious commodities such as gold or silver, which had historically supported currency values. Yet in this version 2.0 of Bretton Woods, the greenback has remained the dominant world currency. If factoring in the euro, the world's number 2 currency, the US and EU are the clear central forces in currency trading value and in foreign reserves. Not surprisingly, this disproportionate power wielded by the West in the global monetary system has stoked dissatisfaction among non-Western nations and a persistent interest in a new type of global currency architecture. Observers in the mainstream of global economics have speculated about further revisions to Bretton Woods' system as well. Amidst the devastation of the 2007-2008 global financial crisis, the economist Nouriel Roubini wrote in 2009 about a Bretton Woods III. Roubini's argument was that trade and current account surpluses, which favored China and other Asian economies, were creating the conditions for a new global currency system. Roubini at the time enjoyed an especially stellar reputation as one of the few who had actually foreseen the housing market bubble that set off the financial crisis to begin with. Nevertheless, his speculation about a third version of Bretton Woods has so far never come to pass. The recent postulations of a Bretton Woods III being advanced by Zoltan Pozsar are more elaborate and more specific than Roubini's. Here are his key arguments. 1. The G7 seizure of Russia's foreign currency reserves destroyed the foundations of Bretton Woods II. That itself is a major assumption, by the way, and not a generally accepted premise, but it's Pozsar's starting point, so we'll just go with it. Number 2. Since Russia is the world's largest exporter of commodities, and by this he should mean oil and petroleum products specifically, Western sanctions have created a supply shock similar to OPEC's 1973 oil embargo. Yet ironically, in this case, the supply shock has been induced by consumers rather than producers. 3. This all equates to a commodities crisis. According to Pozsar, the only one capable of resolving the crisis is China. Beijing is aligned with rather than opposed to Moscow and can buy up price-depressed Russian commodities. It can even deploy a fleet of cargo ships to act as floating warehouses to help absorb the volume. In conclusion, Pozsar argues that the final result will be a severely weakened US dollar and a massively strengthened renminbi. Voila! The renminbi rivals or exceeds the power of the dollar. Critically, the staying power of China's currency would be backed by a basket of commodities. That echoes how the dollar was once pegged to gold in the original Bretton Woods structure and fits with how currencies historically have been backed by highly valued commodities. Intriguing ideas, to be sure, but does any of this really make sense? In a word, no. As disappointing as that might seem to the many hoping to see a major shakeup in the global monetary system, what Pozsar describes just doesn't add up. As a kind of thought experiment about systemic currency values and an illustration of the power of unintended consequences, Pozsar's Bretton Woods III postulation has its merits. But it's hard to see much relevance beyond that. His ideas are simply unrealistic. For one, his central thesis that China would tie its currency to a basket of volatile commodities is completely antithetical to China's established core monetary policy. Totally out of keeping with other major economies, China prohibits free-float convertibility of its currency. Why? Because China's one-party state abhors instability and lack of control, especially in its finances. The overriding objective in China's monetary policy is to eradicate volatility. It's true that China aspires to have its currency, the renminbi, replace the global influence of the US dollar. At the same time, China's refusal to offer the world a freely exchangeable currency makes that little more than wishful thinking. Added to all of this, China operates a closed capital account. That makes large currency movements in and out of the country impossible without government approval. The policy further eliminates another key feature in the workings of foreign exchange that China must offer if it is to ever replace the US or even the Eurozone as a dominant power in a third version of Bretton Woods. Final point relates to the specifics of Western sanctions against Russia. Although China has not joined Western-led sanctions, it has been put on stern notice not to disrupt them either. China stands to lose out further on already severely strained economic relations with the US and Europe if it fails to comply. Those warnings are backed by economic heft. China's trade in commodities with the EU is worth about $760 billion annually. Trade with the US, about $660 billion. Trade with Russia, that comes in at about $150 billion. That's close to 10% of what China trades with the West. At the end of the day, whatever commodity values China can absorb from Russia, it will be orders of magnitude less than what it stands to lose with its Western trading partners. This further reduces any incentives China would have for massively accumulating Russian commodities to establish a new peg, assuming it even wants to establish a new peg, for its currency. Undeniably, the current version of Bretton Woods III leaves much to be desired, and China would like nothing more than to have its renminbi replace the power of the US dollar. But the economic realities of today just don't support a China-centered Bretton Woods III.